It's 6 o'clock in London, it's 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world today. My name is Patrick L. Young. The IPO-VID Livestream, episode 101, starts here. Ladies and gentlemen, we are recording today to fit with the schedule of our magnificently special guest, Bob Pisani, in which case I can't actually bring you the latest news that we've seen in the world of exchanges. Heck, things are moving so fast in BitCarnage, I can't even tell you whether we still have a Binance or indeed a Bitcoin economy. Those are the sorts of things that are happening at light speed. And a man who really understands the business of light speed is our guest today, Bob Pisani. The topic is Bob Pisani, shut up and keep talking. Well, if you're in financial markets, our next guest needs little or no introduction, I believe. He's been a CNBC reporter since 1990. Bob Pisani has covered Wall Street and the stock market for 25 years. He covered the real estate market for CNBC from 1990 to 1995 and then moved on to become Stocks Correspondent in 1997. Having been based in the New York Stock Exchange for what must be an incredible, exciting generation, over 10,000 different iterations of the New York Stock Exchange Bob has brought us his life experiences of investing, markets, and related issues. Shut up and keep talking. Lessons on life and investing from the floor of the New York Stock Exchange was published in October 2022. Bob, welcome to the show. Let me ask, where in the world are you today?
Thank you, Patrick. Pleasure to be on with you. I am in my office at the New York Stock Exchange, just off of the floor, where I have been since, as you said, 1997. It's 26 years at the New York Stock Exchange. It's quite a privilege to work for a great company, CNBC and NBC, but also to be part of another organization, the New York Stock Exchange, for so long. It's a great privilege.
Quite an incredible story altogether. So how did you get into this business? I mean, you started as the real estate correspondent for CNBC.
Yeah, I grew up in the real estate business in Philadelphia. My father was a apartment builder in Philadelphia and in the suburbs around Philadelphia in the 1960s and 70s. And I grew up working on the jobs, literally carrying lumber around. In 1985, he started teaching at the Wharton School real estate course. He was friends with the head of the real estate center at Wharton in Philadelphia. And he called me up and said, well, I'm teaching a college level course and I need your help because I've never taught one before. And he brought me in. I started teaching there too. And we used the course curriculum to publish a book with John Wiley, a respected publisher, in 1989 called Investing in Land Fundamentals of Real Estate Development. And it was essentially the course, and the book came out by sheer dumb luck. Literally the month CNBC went on the air, which was April of 1989. I was friends, again, dumb luck, with one of the first producers at CNBC. And she called and said, you got this book out, why don't you come on as a guest? And they had me on as a guest. And eventually the following year, 1990, they hired me as the real estate correspondent. And CNBC was a startup. They started it really to compete against CNN, but they didn't want a general news show, so they wanted a slight financial bent. So they started putting the ticker below us, and we kind of became the stock market network into the mid 1990s. It all changed about 1995, the Netscape IPO. Everyone discovered this shiny new object called the internet, and all of a sudden we started getting ratings, real ratings. And from 1995 to 2000, it was an enormous upswing in our ratings. We became the biggest thing on television. I switched to the stock market because it was obvious that's where the action was. Came on the floor in 1997. And let me tell you, Patrick, I hope everyone in their life has a period between, like I had, between 1997 and 2000, when the wind is at your back, your career seems like it's taking off, everything is going right, you're going out to you're working all day long, going out to fabulous events in the evening, and you kind of know it's not because you're a genius. You kind of know that it's because you're in the right place at the right time, but it doesn't matter. You're having so much fun. I hope everyone in their life has a period when that period has a 1997 to 2000 in their career when everything goes right and you just feel terrific. And I have tremendous memories of all those times, as well as everything else, and talk about it in the book as well. One quick thing about the title, people always ask me, what does that mean? Shut up and keep talking. When the publisher bought the book, he said, I need a title. And I said, I want to call it Lessons on Life and Investing from the Floor of the New York Stock Exchange, because that's what it's about. He said, well, that's nice, but that's a subtitle. That is not a title. I need a title. Now, what do they say to you when you're waiting to go on the air? I have these, this is called an IFB, it goes into my ear, and it's a wireless, and I can talk to the control room, which is in a different state, by the way. And I said, well, they can say anything they want. Hi, Bob, you're talking to Carl, you're up next. But usually there's some variation on the phrase wrap, which means shut up, or the phrase stretch, which means keep talking. So I said, they can say anything you want, but usually there's some variation on shut up and keep talking. And he said, that's it. That's the title. Shut up and keep talking. So that's how you get it.
Well, that's a great story altogether. And it's quite incredible because obviously we met just a few weeks ago at Boca Raton at the FAA conference, where you did a masterful job of, well, I think it was to some degree executive cat herding, because you'd no fewer than 9 different exchange execs on your panel, leaders of the world's leading exchanges like NASDAQ and the Intercontinental Exchange and the CME, etc. But it must have been very daunting going on to the New York Stock Exchange floor in 1997.
Yes, it was very daunting. When I got here, there were 4,000 people on the floor of the exchange, and they did trading, and 80% of all the trading in the New York Stock Exchange happened on the floor. 4,000 people. And if you want an example of what technological disruption looks like, this is it, because it went from 4,000 in 1997 to today, 250 maybe, that do 15 to 20%. So imagine this, 4,000 people that do 80% of the volume, 1997. Today, 250 do 15 to 20% of the volume. That's technological disruption. But when I got here, this was an elite club. It was really a fraternity of people who had seats or licenses to trade on the floor. The luncheon room upstairs was a famous place where if you got in to get your, big thing to have a client come in, have lunch upstairs with everybody. It was an enormous operation. And what happened was the market changed. Electronic trading came in the 1990s that, in a large sense, made the market more efficient. It was faster and in some senses more efficient than the old open outcry that was available on the floor. So the biggest problem I had was just getting people to trust me. You're dealing with an elite fraternity down here, and they don't see any particular reason in talking to a reporter. And you have to be able to get through to them. And the people who really helped me were people like Art Cashin, the head of floor trading at UBS, now the head of at UBS. And a few people spoke up for me and said, okay, you can trust them. What they did not want to hear, they didn't mind you showing or talking about, well, oil stocks are moving this morning or pharmaceutical stocks are being sold. They didn't want anybody going on TV talking about anything they were buying and selling personally, because that was a fiduciary, that was a personal business matter, and they weren't sure whether they could trust anybody to not do that. And once they realized that I wasn't going to do that, that I really was looking for color, not specific trades they were doing, they relaxed, and it got a lot better. But boy, let me tell you, there is nothing like being on a floor with 4,000 people screaming at each other. You got to learn how to concentrate really quickly, and literally you get drowned out if you don't know how to scream above the crowd.
Yeah, absolutely. It's an incredible job. And particularly when you're not actually part of the trading crowd and you're trying to do your own job, presenting to all those millions of TV viewers right across the world who are watching CNBC on all 4 corners of the earth. It's fascinating, though. Of course, nowadays you've become an established name on the New York Stock Exchange floor. Heck, you've even had the opportunity to travel. And I mean by that, you got all the way up to the library recently because you were talking to the excellent folks of the Inside the Ice House podcast. So it's always a joy to have someone else who's a fellow alumnus of that particular exclusive group. I think you're number 323. And I must admit, I was jealous. I mean, reading your book, it's a great book, ladies and gentlemen. You've really got to get out there and buy it. It is a super read about everything, behavioral finance, electronic markets, the whole history of the New York Stock Exchange over the course of a generation. It's all in there, and it's a thoroughly good read. I must admit, I was jealous, not jealous per se over the fact that you've met the Robert Downey Jr.'s and you've met the Jack Ma's of this world and so on, but actually some of those incredible trading names that you mentioned. I mean, Burton Malkiel, who writes the foreword to your book, Art Cashin, who you've just referred to. It must be absolutely amazing to have met the truly great figures of a whole generation of investor.
Yeah, there's a chapter in the book called The Wizards of Oz. In the late 1990s and early 2000s, I had this silly, ridiculous quest. And the idea was, I'm going to find the perfect traders. It's a small group. I was convinced there was a half a dozen. I was talking to 500 people. Literally, I had my old contact list from 1999, 500 people. And basically the quest was, there must be somebody who knows everything about the market, who can be a confidential source of information for me. And if I put 6 of them together, I would essentially not have to work so damn hard. I'd have the perfect market information with 6 people rather than talking to 500 people, and I'd sound like a genius and life would be a lot easier for me. Well, that was a stupid idea. First off, I found out there is no such thing as a Wizard of Oz. It doesn't exist. I also found out that the world gets more complicated, not less complicated, which makes things even harder on you. But one of the things that I did do when I wrote that chapter was, one of the things, there is a series of themes that are very common amongst the best traders. And I'm talking about people who actively trade, market makers who see things, or people who actually trade their own money or on trading desks. And I would say the most common comment I heard from people who want to be successful traders is to manage your losses, not manage your gains. All of them. That was the most important thing they said was, gains will take care of themselves. Losses do not. You must be proactive very quickly in recognizing a loss. You can never hope for a stock to come back. You've got to recognize that. And if there was one thing, and again, this is in that chapter, there's some other points, is managing the losses is what saves people, and the failure to manage the losses is what kills people. So if you want one general story, is pay attention to your losses.
Yes, pay attention to your losses. And I think the other thing that you're very good, I mean, the maxims you're bringing out here to help the trading public. You mentioned the fact that getting rich slow is a lot better than getting rich quick, which I think is something that people perhaps miss, because there's all of this incredible frantic activity on the floor of the New York Stock Exchange every day, and the average investor feels they have to be part of it.
Yeah, yes, that's disturbing to me, because if there's anything that I've learned, I'm basically a Jack Bogle disciple, a Vanguard type person, is that the urge to trade should be suppressed for most people. There are very few successful day traders, and the academic literature is overwhelming. You're likely going to lose. The best way to gain wealth is slowly. It's to have a diversified portfolio, and not even individual stocks, but indexes, stocks, bonds, small number of bonds, some diversification in real estate, for example, I've always believed in. But if there's only 3 things that I saw that really educated me in the last 33 years, I saw the birth of electronic trading and decimalization. I mentioned what that did to the floor. I saw the growth of passive investing and exchange traded funds, and the domination, the victory of Jack Bogle and Vanguard, that it was the most important thing was to stay with the market, and that market timing, trying to say I can go in and go out, does not work, because you have to be right going in and you have to be right going out, and your chances of error are very, very high. The most important thing is have a long-term plan, understand where you are in your life cycle, how many years do you think you're going to be living, when do you want to retire, and what kind of mix of stocks, bonds, real estate, or other assets, even collectibles, that you might want to have and that you're comfortable with. Some people are nervous with a 75% of their 401k or investment in stocks. Other people aren't. I can have a discussion about that if you want, about what I think is working. But most people don't have that kind of plan, and that's the most important thing to do right now. So if there was any other thing that I saw that was really important, and I have 2 chapters in the book about this, it's about the development of behavioral finance. Behavioral finance purports to show how people really behave, not how they're supposed to behave. So in the old school way of thinking, going back hundreds of years, people were rational actors, rational economic actors. You buy low, you sell high. And what everybody discovered, people who were really closely examining this 40 or 50 years ago, is that doesn't happen. It's just some kind of imaginary thing. People don't buy low and sell high. They buy high and sell low. They act in the opposite direction. Why do they do that? And it turns out that there is all sorts of problems. There are 2 main problems here. There are biases that are out there that infect people's thinking and make them unable to think rationally. So there are biases, for example, that are faulty reasoning, and there are biases that are emotional. So think about this. People get things like overconfident. They come to believe that they're infallible when they're on a winning streak. That's a bias. People make that mistake all the time. There's confirmation biases. People select information that supports their point of view, and they ignore anything that doesn't support their point of view. That is a very serious bias. That messes up a lot of people. So the great thing about recognize this is that there is a slightly irrational component to the stock market. People ask me, is the stock market efficient? I say, listen, you're going to exhaust yourself trying to figure this out. My position is the stock market is efficient enough, but there is definitely some irrational component in it because people don't act rationally. So understand that and understand that stocks can be a little mispriced, but don't worry about it. The big thing is behavioral finance gave a very big boost to the indexing crowd, because unless you want to endlessly analyze yourself and figure out your biases and everybody around you, passive investing made sense because it reduced or eliminated a lot of those biases. Now, you can have some biases just by having an index, that's an index bias, but it reduces the chances of mistakes. So the important thing is understand those biases, stay with the market. Don't think that you can pick stocks. Don't think that you have an information advantage. I think that is a real bias, confirmation or overconfidence that somehow, oh, I have information no one else has. You don't. You really don't. So the other final thing I'll say, Patrick, about this is you can explain this to people. And you can explain these biases to people, and they'll get it. They'll say, yeah, oh yeah, I exhibit overconfidence all the time. And so it's possible to train people to think more rationally about investing, but I've stopped expecting too much over this. I've changed in the last 10 years or so. I think investing wisdom and insight remains in short supply because, number one, financial illiteracy, Patrick, I think is still really widespread and maybe even worse than 30 years ago. When we started CNBC, we said, oh, we're going to educate people about how to invest. And we've been doing this for 30 years. I don't see suddenly the country has got more financial literacy or that they're able to think more rationally. I don't get that impression. And then even people who know better continue to make dumb mistakes because overriding these biases in your brain are really hard. And in the book, I describe several chapters of my entire investing history. And I even tell you what I own right now. If you're interested, you can find out. But I describe my entire investing history and my disastrous decisions back 30 years ago, buying General Electric stock, which owned NBC, my overconfidence in Jack Welch, my failure to take losses when GE stock collapsed in the early 2000s. I did the same stupid things that I describe in the book and say, don't do this. I did it. And worse, Patrick, I knew I was doing this. I wasn't like, oh my God, I didn't know about behavioral biases. I learned about it later. By 2000, I was very aware of the results of the studies on behavioral economics, and I still did it. What does that tell you? That tells you that it is really hard to overcome these biases. So I describe them. I think people should be aware of them, but I have very limited confidence that somehow the world's going to change just because I can label a certain bias.
Yeah, well, I mean, I think we also see that these days, don't we, in terms of the internet has more or less every fact that we ever want in the world. And then suddenly you get ChatGPT goes and reads it all and comes out with often fabulously accurate prognoses, but at the same time, some hideously inaccurate prognoses, thanks to the wonders of artificial intelligence. So what chance have we mere mortals got? I'm really interested in a couple of things. I mean, I want to take you back a step to, you talked about being on the floor at one stage in the mid-2000s. And I think that really was the nadir of the NYSE. I mean, technology was eating at the business, but it was eating at it the wrong way. It was before the ice age, before the whole business turns around. What was it like to be there then?
Well, it was depressing. I said I hoped everybody in their career can have 1997 to 2000. And what happened in 2000, first off, was .com bubble blew up. That only affected a very small group of people who were fanatically involved in buying and selling tech stocks on a daily basis. They got essentially wiped out. But it was not it sort of shattered confidence in the internet briefly, but it wasn't a big macro event for the stock market, for the economy, excuse me. But when 9/11 hit, I was outside. I saw the second plane hit. I was here for that whole thing. and the months and years past it, that was a real emotional blow for everybody. There were suddenly 3,000 people dead. Everyone here had friends who died. I had friends who died in the first building, the first plane that hit the building. It got hit by the first plane, North Tower, and the air smelled bad. It's hard to describe what it smelled like down here for 1 year, not a week, a year. People were afraid of other terror attacks. The economy went into a recession. People down here, trading was much lower because the dot-com bust had ended, and it was a really difficult time. I actually considered leaving. I thought, this is a good 11-year run. Maybe I should just do something else. And what I did that saved me, and I described it in the book, I learned how to meditate. I actually joined a Buddhist meditation society that taught me what you are anxious about had nothing to do with your own behavior. These are events that happen outside of you. Nothing about you fundamentally has changed. And you need to change with that and learn to accept that and not fight it. And there's nothing that happened that you did anything about that had anything to do with you. And it helped me. And in fact, I went and re-signed my contract when I was thinking of leaving because I spent 6 months doing that. So, but what happened after that, though, was a long, slow descent for the floor as electronic trading just came to dominate everything. And in 2006, the NYSE went public. Yep. The NYSE had been a mutual company, literally a private club. It was owned by its members. You had a seat, and the seat holders controlled it. And so in 2006, it went public. And I'll never forget this. The luncheon club was famous upstairs. I mean, but it operated at a loss. It didn't make money. It was basically there for the members. It was a private club, and they closed it when it went public. John Thain, who was the CEO at the time, closed it because it was losing money. Now, I understood why they did it, but let me tell you, emotionally, that was a big day. And people like Art Cashin that hung out at the bar every day, with what we call the FOF, the Friends of Fermentation, picked up, I'm not joking, literally picked their glasses up and went across the street to Bobby Vans and camped there where they were until the pandemic hit. And that kind of destroyed the spirit of the NYSE. A lot of the camaraderie that existed kind of went away after it went public. And they closed the luncheon club. So my attitude about this is I am happy and proud to have been here at its very, very height in the 1990s. But you cannot be nostalgic about any of this. Recognize what happened. This was a case of technological disruption. Nobody set out to destroy the floor. Nobody set out to be evil. It's just natural evolution of the financial system and the technology that's involved. And you have to believe in the future. You have to keep pushing forward technological innovation, financial innovation. That's how the country grows. That's how we get better. Even ChatGPT, which everyone is freaked out about, and I can chat about it if you want for a minute, that is another new technological innovation that we should figure out how to embrace and make people's lives better. Remember, that's what we're in, Patrick. That, what
Yep.
business are we in? I thought the guys on the floor, well, we're in the stock trading business. Now that may be true, but that's a small little area to think of yourself. You can say, well, how about broader? Well, we're in financial services. Okay. The way I think about this, we're really in the dreams business, Patrick. We are in the business of helping people realize their dreams and aspirations, their retirement, helping put kids through college by investing. That's a broad way to look at what our responsibilities are. So we can't sit around and be nostalgic about the floor of the New York Stock Exchange. I'll write a book about it and tell you about it, but I'm not nostalgic for it. I'm eager to talk more about what's the future. How can we improve the world and make things better through better financial services, better technology? You get the point.
I totally get the point, and I'm totally with you, because we're all in the growth business and delivering dreams, and that becomes very, very interesting when we look forward. So I'm curious, I mean, how do you see from the fascinating, privileged, if I may say so, bubble of the New York Stock Exchange floor every day with these 250 remaining floor traders, how does that affect your worldview going forward?
Well, I'm trying to think how to answer that. I think the way to look at it is it's a long day for me.
Right.
I get up at 5 a.m. I used to check the the Tokyo stock market. Now I just look at S&P futures. And then I come in, I look at earnings reports, upcoming economic data. But largely I read emails. I get about 600 emails a day. And most of it is strategist and analyst report. Here's what our home building analyst said about, the home building report. And I make a few phone calls. I make far fewer phone calls than I did 20 years ago because it's more efficient to either send emails back and forth. And I also found that I don't need to talk to 100 people a day. If I talk to 15, that's enough. But they have to be the right 15, the people who can help me answer a question or show me something that I don't know already. That's a real big problem when you're a guy like me, when I literally see so much stuff. It's rare when somebody says something to me that, oh, shit, I didn't think of that. Wow, that's a good point. And that's the highest respect I can give to any journalist or any strategist or analyst or anybody. Oh, you just told me something I didn't know. So you look for those people, not the people, the 99% of the people who tell you stuff you already know. You look for the 1% who tell you something that you don't know. So the way to look at this is, I think of journalism as like 100 sticky notes on the wall. Come in and they're all blank. There's nothing. There's 100 sticky notes, and your job is to fill in each one of them with the facts. But that's not enough, because a fact isn't an understanding. You're not going to help anybody telling anybody home sales went up 1% in January. You need to connect the dots. That's what journalism is. Journalism is storytelling, and storytelling is showing how those 100 sticky notes on the wall with the one fact, how they're all connected. That's the real skill of journalism. And frankly, that's my primary skill set. And that's what I spend most of my time staring at stuff, thinking, okay, what's really going on here? What's the trend? And you'll hear me talk a lot about trends and momentum. And it just comes about from me just staring at this thing. So you build up this body of knowledge. You've got this, Patrick, over 30 years where I'm as good as the people I talk to, my sources. I call them up. But I've been doing this so long, I know as much as they do, and in some cases, I know more than they do. So the reason they keep somebody like me around all these years is for that accumulated knowledge and the help it brings in developing stories and developing a narrative of what is actually going on. So if you ask me what I spend most of my time on, that's it, developing narratives and understanding of the markets.
And I think the fascinating thing is also, not only do you develop these narratives, but you've got to get them in essentially 5 minutes. I mean, you don't have the luxury of 1, 2, 3 hour shows. You've got to hit people with the whole story in very, very short, sharp bursts.
Yeah, it's the part of the thing here is, yes, there are different platforms. So in the morning, I have a thing called Trader Talk, where I'll type up some thoughts that I have on what's going to happen in the next day, or something interesting that's happening that day. And I'll have some room to write. I'll have an editor, but I'll have room to write a lot. When I'm on the air and they're looking for hits on the market, it's a little different. I'll typically have 3 minutes, 4 minutes, something like that. Maybe the anchor will interact with me, but you're right. You have to be able. So it's not just having a narrative, it's compressing it in some way. And a lot of times that's part of the skill and part of the annoyance, frankly, because you've got 5 minutes of things you want to say in a 3-minute hit. And you can talk fast if you want, but oftentimes you're ending up editing things in ways that fits the format that they have. So a lot of ways, Patrick, you're like the weatherman for the stock market. That actually, weather metaphors work well with the stock market. An ill wind blowing in, we're having all sorts of headwinds and tailwinds. That's a common metaphor to describe the stock market. And so on days when the weather is really bad, they drag me on more. Explain why the weather's really bad, Mom. And when it's really sunny out, the producers, they might go talk to somebody about some other, investing in wine or comic books or something like that.
I think it's a great metaphor, because I think once upon a time I said that the trouble with weather forecasting is that it's right too often for us to ignore it, but it's wrong too often for us to rely on it. And I suppose that brings us to the prediction business, because you write a lot about that in your book. And really, the prediction business is fundamentally mediocre. Yeah,
my favorite part of the book was when I had to write down my thoughts about something that has always bothered me, and that is, why is everybody so bad at predicting the future? if you have a half a brain and you're involved in this for more than a year and you're thinking about what is going on, you're going to have a sense that these prognosticators are terrible. And it's not any one. You can't sit around and say, oh, these day traders who try to pick stocks, they're terrible. Well, it's true. But professionals who try to pick stocks are terrible. We do studies every year on this. 90% of active fund managers underperform their benchmarks over a 10-year period. 90%. The professionals are terrible. Then analysts are terrible at picking prices on stocks a year from now. Strategists, high level, Morgan Stanley, Goldman, terrible. Here's the worst one. The Federal Reserve has a terrible track record of predicting the U.S. economy even 1 year from now. How is this possible? These people, the Federal Reserve in theory have the best people on earth. They can't get this? And it turns out, there's a whole chapter about this because it made me nuts for years and years. There's two problems. The first problem is that predictions are riddled with these biases and noise that I talked about. The behavioral economics problems are the same that you have in the prediction business, and that those biases limit the quality of the predictions. So that's one, and I give a lot of examples of that. The other problem is a sheer informational problem. There is a lack of complete information because the events occur that are unpredictable and that can affect the outcome. So just think about this. Just make something simple up. You're a Caterpillar analyst, and your job is to predict the price of Caterpillar 1 year from now. So you think, how hard is that? It's just Caterpillar, right? And you have an estimate on earnings. And it turns out there are literally thousands of things that can affect this in the next year. It's December. You got to predict Caterpillar's price. December of next year, the CEO could get up and leave, could become ill. We could have some new giant competitor in. China economy could fall apart. It's 40% of revenues for Caterpillar. It turns out when you start adding in the factors that can affect the stock price, it's so big that it dramatically increases the scope for your forecast to go wrong. And so you combine the behavioral economic problems with the lack of complete information, and the prediction business becomes very difficult in general. Now, there are efforts to improve the quality of predictions that have been going on. There's a wonderful fellow named Philip Tetlock at the University of Pennsylvania, and he has a wonderful one. I encourage you to look it up, called the Good Judgment Project, where he actually tries to train people to think more critically and think in a broader way. And I'd highly commend that. But I have to deal with the facts on the ground. And the fact is, when you see this and you understand everybody's lousy at the prediction business, this makes you very humble about going around making predictions of your own, number one, and number two, relying on other people's predictions. This gives another boost to the indexing crowd that say, this is a stupid thing. You trying to guess or relying on somebody else to guess where Caterpillar is going to be a year from now is a ridiculous quest. You should give it up and just have a long-term plan and stick with the market. So that was my favorite part of the book, because I think that's the absolute key. When people ask me for investment advice, I'm not an investment advisor. I'm telling you what I've learned for 33 years. And one of the key things I've learned is you think you can predict things, you can't. And so be more humble about that. I'm not saying don't look. I read predictions all the time, but I have much less weight to them intellectually than I did 20 years ago.
A magnificent surmise. So let me ask you the last question that we always ask our guests, going back to my first book in 1999 during your salad days era when you were first on the New York Stock Exchange floor. Bob Pisani, where do you think the capital market revolution goes next?
It's going to become even more electronic. Artificial intelligence is going to become a very important part of it. There will be new products out there. People ask me about what's going on with crypto, and I have a very simple answer to this. I am a huge believer in blockchain. I am a huge believer in the concept of decentralized finance. I think that there's tremendous potential there for real estate transactions, for transferring money, for stock clearing in the blockchain. I don't have a particularly strong opinion about Bitcoin or cryptocurrencies since they're artificially created. There's nothing behind them. So I don't have they're collectibles to me. I don't have an opinion on where the price of Bitcoin is any more than I do about the price of rock posters. You see this behind me? I collect old 60s rock posters. This is a Rolling Stones poster from 1972. It's very famous. But what's this poster worth? Yeah, it's worth whatever anybody will give for it. It just sits here on the wall. It doesn't pay a dividend. At least I haven't gotten one yet. It doesn't have a future stream of earnings like a stock. It doesn't do anything. It just sits there. And so it's hard to figure out what something like a cryptocurrency is actually worth. So distinguish though between a cryptocurrency, which like a Bitcoin, which is a cryptocurrency running off the blockchain, and the concept of the technology itself. So I go back to my original point here. Keep pushing financial innovation. Does it mean everything's going to be fabulous? No, there's a lot of baloney in crypto. Don't you know that already? There's not only just fraud, there's just baloney. Now, fraud is deliberate. Baloney is just bad ideas. But there's core of great things there in blockchain that have tremendous implications. And that you have to be able to learn to distinguish that. What's the umbrella idea is don't get stuck in the past. Don't be happy about the past like I am, but don't be nostalgic about it. Keep pushing forward. Keep thinking and believing things are getting better, because if not, what are we all here for? I don't understand. There's a chapter in the book about the glass half empty people. I have never been able to understand those people. I'm a glass full guy, a half full guy. I look for reasons to get up and be happy in the morning, not reasons to get up and be unhappy. I look for reasons to get along with people, Patrick, not get along with people. And yet, 33 years on Wall Street, I have met a lot of people who actually are glass half empty and who are disruptive. And I find it hard to believe. So one of my life's journeys has been believe the world's getting better. I don't know about you, Patrick, but I can't get up in the morning thinking, life sucks and it's not going to get any better. That's basically the attitude of the glass half empty crowd, and I'm not willing to play that game. I got
absolutely.
A different game. So
look, my viewpoint is, how can you be in the dreams business if you're not going to have a better day than yesterday? And that just seems fundamentally it. Ladies and gentlemen, it's time for us, unfortunately, to shut up. But at the same time, I want you to keep talking. Beautiful linkage between the future of blockchain and the exciting things there. And our last guest, James Block, who was magnificent. Our next guest was somebody who was also honored in Boca Raton recently, James Oliffe, former deputy chairman of the Chicago Mercantile Exchange. We're looking forward to talking about markets and electronic transition with him. I want to thank our fantastic production team today. Thank you to Beata, thank you Fernando, thank you Janella, thank you Jamil. Most of all, I want to say, before those magic 3 words that he's been so used to in his CNBC career, thank you very, very much, Bob Pisani. I wish we had more time to talk, but I appreciate you're such a busy time. It's time for us to shut up and keep talking. And ladies and gentlemen, it's a wrap.